This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 96. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode of the Planet MicroCap Podcast, I spoke with Gerry Frigon, founder and CIO of Taylor Frigon Capital Management. At the beginning of September, when we recorded this interview, mainstream media outlets have been discussing the effect trade wars, interest rates, and all sorts of potential catalysts for downturns in the market. I thought it would be important to discuss investing strategies in the event of downturns in the market. I was introduced to Gerry Frigon very recently and thought he would provide some interesting takes on current market conditions, how he and his firm would tackle downturns in the market, and to learn more about Taylor Frigon Capital Management's investment philosophy. Thank you again for tuning in to episode 96, and please enjoy my interview with Gerry Frigon. But first, a word from our sponsor. Hi everyone, Robert Kraft here, your host on the Planet MicroCap Podcast. As some of you may know, when I'm not interviewing folks for the podcast, I also host CEO video interviews and Wall Street Views with investing experts for SNN's YouTube channel, SNN Network. I wanted to take a moment to invite you all to subscribe to the SNN Network YouTube channel. As a subscriber, you'll be the first to be notified when we publish a new CEO video interview with microcap management teams, a new Wall Street View video interview with investing experts, panels and keynote presentations from our conferences, as well as new and archived podcast interviews. Go to www.youtube.com/SNNWire and click the subscribe button. Again, that's www.youtube.com/SNNWire and click subscribe. Thank you for subscribing and for your continued support. For this episode of the Planet MicroCap Podcast, I would like to welcome Gerry Frigon, founder and CIO of Taylor Frigon Capital Management. Gerry, welcome to the Planet MicroCap Podcast.
Yeah, thank you very much for having me.
It's great to have you on, and thank you again for joining me. So to start off, let's get your background. How and why did you start investing in the stock market in general?
Well, I've been at this for 34 years. I spent 21 years with a large Wall Street firm, actually Merrill Lynch in San Francisco, and really kind of cut my teeth on the retail side of the business, but had very early into my process of doing that, realized that I wanted to be an asset manager. Mm-hmm. I was fortunate to have married a woman whose father was an asset manager, Dick Taylor, who's now is one of the namesakes in our firm, Taylor Frigon. And really, I tell the story that it took him about 5 years to really figure out what I had done, because my wife is the youngest of six, 5 girls. So he had his hands full there. Nonetheless, once he finally figured out what I did, it didn't take long for us to become fast friends, and frankly, for him to become my mentor in the business. So a good 15 of the years that I was in the Wall Street firm, if you will, he was really mentoring me on asset management, how it worked, the whole concept of what we call that growth stock theory of investing that he learned from his days back in the 60s, working side by side with Thomas Rowe Price back in Baltimore. My wife is originally from Annapolis, Maryland. And so, from that, I just, built on, what I had learned from Dick. Unfortunately, he passed away in 2004, so was actually not even ever a part of our firm, because we didn't start Taylor Frigon until 2006.
Mm-hmm.
But nonetheless, that's the origins of my investment, or my investment background, and the reason why I ended up getting into investing in growth companies.
So even before entering the main, going to a Wall Street firm, going to Merrill Lynch, did you have an interest in investing prior to that, or did you study it in college? I always find that usually everybody I interview sometimes has that story where they're either their parents pulled that one can off the when they're at the market, and they said, "Oh, look, this is a public company. I invested in this one." And, "Oh, Mom, what's investing?" So, I mean, I'm just assuming you must have one of those stories.
Actually, I really didn't. I didn't have a ton of money growing up. My family was not endowed with lots of money, and so, frankly, and I went to UC Santa Barbara as an economics major, so I was very interested in economics and business, and I think early on did know that I wanted to get involved in working with other people and their money, probably because I didn't have that much of my own. So it was really more of a means to an end. In other words, I knew that could be, this is the mid 80s, right? So it was kind of popular to be in the financial world at that point in time. I did love economics. I thought it was particularly, interesting, and I was, I enjoyed my time learning about it. But I can't say there was any one particular, stock picking event in my past, or before I got into this business, or even before I got into, studying economics at UC Santa Barbara, that, that led me to this. It was more, I knew that was a way that you could do well. And somebody said to me, if you want to make money, manage other people's money. So I kind of took that as, okay, well, maybe that's a way that I can find some level of success out there in the world. One thing led to another, and and here we are. I was actually a baseball player in college. So frankly, going into college, probably my bigger interest was, I want to play pro baseball. So that didn't happen. But nonetheless, here we are today doing what we're doing.
Cool. I got to tell you, I mean, I feel like we almost had similar paths. I went to UCSD, and I was recruited to play ball there. And then one thing led to another. I ended up not, because it was, time commitment was a little too much. But I had a very similar thing to you. My dad was on Wall Street for years, so I kind of got inspired to want to be in it eventually from that. But I had a very similar mindset of baseball and school at the time.
Absolutely.
Yeah. So you alluded to this at the beginning. What then eventually led to your found? What inspired you then to go from Merrill Lynch and from the working in a firm to starting your own shop?
Yeah, I mentioned to you before we got on the podcast that I kind of regret not having started this earlier. The business was evolving and changing quite a bit, even by the mid 80s, with respect to, what was formerly the quote unquote stock brokerage world, where you got paid a commission to pitch stocks to people. That never appealed to me. I always kind of thought that was, somewhat, and I hate to say this because it sounds terrible in some ways, because there definitely were some great old stockbrokers out there that really were asset managers, but it had this negative connotation about it, and the whole concept of churning, and I think that was probably overdone as to how rampant it was. I don't think it's like anything. 99% of the people out there are doing things honestly and trying to help people make money. There's a few bad apples out there that kind of ruin it for everybody. But nonetheless, I kind of like that idea of, let's get paid an asset management fee, or, based on the assets, and have it not be related to the transaction. And then you could just kind of focus more on buying businesses and not be so worried about, well, geez, I got to generate, the way I generate income is to generate transactions. So that appealed to me pretty early on. And the business was going through kind of that transition to that kind of asset-based fee, even in the retail brokerage world at that point. And so, I got more involved in that, but then realized, one of the things that Wall Street, the big Wall Street firms did, at that time, and really are still doing today. And I would suggest that it's most of the business today is, they wanted you to raise money. They wanted you to open accounts. They didn't want you to manage money. And that always didn't sit well with me. I always felt that, okay, so there's this line, you go find the money and you open the accounts and then turn the money over to the professionals to manage. And I thought, well, geez, am I not a professional? I guess, I'm an amateur of some kind, so that just didn't sit well. And so, I never stopped with kind of educating myself and trying to learn how to pick companies, how to manage money in the context of a portfolio. And then just the pure, perfection, if you will, of marrying into a family that was an asset management family. And Dick spent most of his time in the 60s and 70s at Rowe Price and learning from a master, who really was, I think, one of the best investors ever. He didn't write a book like Graham and Dodd and put all of his ways of doing things into a highly published or highly distributed type of form. We do actually have an old memo that he put out called The Growth Stock Theory of Investing, that was really his sort of treatise on how to go about looking for great companies. But it wasn't something that it was never turned into a book of any kind. So, learning from Dick and from his experiences back when Rowe Price was, really fairly young in their growth stage, back in the 60s and 70s, was really something that was, amazing. And to this day, I'm so thankful that I was able to have that experience. And, we really are trying to carry it on here today at Taylor Frigon, just kind of, carrying that torch forward and delivering the same kind of really what is pretty simplistic type of portfolio management.
Mm-hmm. Well, Gerry, I look forward to reading that book when you do decide to write it at some point. But so let's dig in then. I'm sure we could do some anecdotes all day, every day, talking about your experience with your mentor and Mr. Taylor's experience also with Mr. Rowe or Mr. Price, excuse me. But I really want to know, what is the classic growth theory of investing? You kind of answered why you decided to use this theory as the basis for your investment philosophy. So let's dig in there. What exactly is it?
Sure. So T. Rowe Price had a tagline that he'd say, you want to look for well-managed, well-run companies in front of future fields of growth or fertile fields of future growth. Sounds very simple. It is. And then followed that on with most of the great fortunes in this country have been made by men that held on ownership of companies through multiple market and economic cycles. And that's true. If you look at the billionaires out there in the world, most of them were owners of businesses that they held for decades. And so that, as simple as that is, it still is to this day what we use as our basic guide to whether or not this is a business we want to invest in. Now, that's a common, or I'd say a common thread that you get from the Graham and Dodds and the Buffetts of the world is, buy the business, not the stock. And that was for sure an overlap with T. Rowe Price. I mean, he said the same things, don't think of trading stocks, think of buying businesses. As simple as that is, I don't think that that's practiced hardly at all today. I mean, most of the asset managers that are out there, largely not necessarily their own fault, are driven by quarterly performance, quarterly numbers. It's kind of the way the world works as far as who gets the money and who doesn't. And as a result, can be much more trading oriented than is probably healthy. And so that concept of owning businesses through multiple market and economic cycles, I mean, think about that. Most of what you get out there is trying to figure out what's happening in the economy and how's that going to affect the business that I'm in. And should I sell because the economy is about to go into recession and I'll try and buy back, or I'll look for something else that might be more prone to or less prone to being affected by recession. I mean, that's not the way the growth stock theory works at all. You're thinking in terms of these are, themes and narratives that are likely to be with us for a very long period of time. And whether the economy goes into recession or whether the market cycles down and has a correction or maybe even a bear market, the reality is that owning companies through all of that, as long as they still fit that definition of being well managed and sitting in front of fertile fields of future growth, you're going to be well served.
Got it. All right, so I want to dig into that point too, because like you said, it sounds very simple and often can probably be oversimplified. But let's dig into maybe some of the criteria you look for when you're evaluating a company that potentially could be well managed and it potentially could be in a fertile field of growth. So what are some of the criteria for those two key points?
Well, I would say, in fact, one of the ways that maybe we've expounded on that growth stock theory of investing, if you will, and one sort of bone I would pick with Mr. Price was for all the talk of buying the business, he uses the term growth stock theory of investing. I'm going to say growth company theory of investing. And we kind of an add-on that we put into this equation was venture capital. And in fact, in our shop, we actually do run a venture capital partnership as well, and often talk about buying public companies with the same sort of view of due diligence that we would make investments in young venture type companies. Mm-hmm. So what's first that you're looking at? The people, right? I mean, if you talk to most venture capitalists, they will say first and foremost what they're investing in are the people that have this idea, the entrepreneurs that are running that business, that have that idea. So we feel you can take that same. First of all, we actually execute that in our due diligence process with venture capital, but we can execute that and take those same tools to the public markets. Mm-hmm. Obviously, what that's going to end up doing for us is it's going to end up migrating us more towards smaller companies. I hate the whole segmentation of the market that goes on where, well, you small cap or large cap or mid cap or whatever. I don't even really like the value and the growth differentiation, because at the end of the day, don't we find value in everything that we buy, or else we wouldn't buy it, or at least that's what we're after. I think it's really important to make that distinction that, if for nothing else, just the law of large numbers and the amount of impact that a company can have as it gets larger is somewhat limited. And so naturally, we're going to be looking for companies that are smaller, or if they are larger, they have to be in front of enormous addressable markets. So when you're thinking in terms of, fertile fields of future growth, what does that mean? For us, what it means is an addressable market that is large in comparison to what the value of the company is now, or what the amount of business the company is doing in that particular market. And actually taking it a step further, what we like even more is if it's a market that doesn't even exist. And they say, well, how do you know how big it is if it doesn't exist? Well, that's part of the magic, obviously, of trying to figure out, whether or not the company has merit is, hey, these guys are creating a whole new market that, if this works, could be enormous in size. So you don't always find that, right? I mean, it can be good enough sometimes to just find somebody that's going after an already existing market that may be growing in and of itself, and perhaps they have a better way of attacking that market, and can take more and more share. It's harder and harder to find companies that are actually creating new markets, but nonetheless, it's in that particular angle, or that direction that we want to go.
Mm-hmm. So not to pose like a straight dichotomy in the options here, because there's so many variables, but for in your theory of investing, if I'm trying to understand this right, would you be looking at it? Let's say you had two companies, one that was by the traditional Graham Buffett value investing was considered cheap, but may not have had these fertile fields of growth, but they had some continuous growth and, good numbers, blah, blah, blah. you have one company there. But let's say you had another company that may not have had the greatest revenues yet, maybe still growing, still trying to capitalize on that potential new fertile market. For you guys, what is more interesting in terms of meeting your criteria?
I think first off, what I would do is I'd define what I think is the difference between traditional value investing and growth investing. The way I like to describe it is I think traditional value investing is looking at the balance sheet, right, where traditional growth investing is looking at the income statement. Mm-hmm. And so if you which you might take that a step further and say that the traditional value investing doesn't really even exist today. Dick Taylor used to say all the time that, kind of the LBO phase or craze of the 70s and 80s sort of took out all the great value plays, and they haven't really existed since. And so what you were left with was value investors who were looking for quote unquote cheap, and we're really becoming trading strategies that we're trying to pick the bottom of a cycle and buy in and then sell out at the top of a cycle. And now you've got cyclical companies that you're just trading based on pure what you perceive to be as value or cheapness, or it's cheap, so I'll buy it. Mm-hmm. That is the antithesis of what we're doing. We're looking at the income statement. We're looking at what the income statement could be. So we're far more interested in the company that you described that's more oriented towards revenue, more oriented towards, growing its business. And the earlier we can find those, the better.
Got it. And I have my quick follow-up too on that is, I always find it interesting that whether it's a large shop, a smaller shop in terms of AUM under management, AUM, it seems that there's always so many different ways to find potential new ideas. What's been some of the more successful ways in which your firm has been able to find and capture some new potential ideas to look at?
Well, it's harder and harder nowadays. We have this kind of saying in our shop that, the 8,000 to 4,000 problem, and those are rough numbers, but that's roughly the number of public companies that we've shrunk to over the last, I'm going to say it's a 21st century problem, that we're not growing public companies the way we once did. Mm-hmm. And so it's harder. We do use the database of those 4,000 companies that are out there to try and munge through. But to be honest, now it's more and more, the networking and it's why we started a venture partnership so that we could find companies that are not public. I think you're seeing this more and more in the private equity world. I mean, companies are either not going public or being taken out. And so it's forcing us to look at the private side of things, whether it be in venture capital or, later stage. Now later stage venture capital is kind of crossed over with private equity. So I think I'm going to answer that question with, it's really in some ways kind of back to the old days. I mean, the screening of databases for certain growth criteria to come up with a list of names that you can explore. I mean, who isn't doing that now, right? I mean, that's beat to death. So you really have to be willing to kind of keep your ear to the ground, make sure that you've got a network of people that are, that you're able to go to for, ideas and what have you that maybe are not as well founded or well understood or known. It's one of the reasons why, and probably something we haven't talked about at all in our pre-discussions, is one of the reasons why we have found great opportunities in Israel. Our portfolio that is our growth portfolio, which is 47 names right now, 13 of them are from Israel. That's really having your ear to the ground, because most of those companies were never in any databases. And it's where some of the best performing names that we've had over the years have come from. Mm-hmm. So much so that we've actually carved that particular part of our portfolio out as a separately managed strategy that's Israeli only. Mm-hmm. Those 13 companies are part of a kind of high concentration, high conviction portfolio that we run separately. Still part of the core growth strategy, but for those that might want to focus on that, we do that. So there's an example of, finding different places to find companies, or going to different places to find companies around the world. and exploit those things which are not as well known.
Dude, we should have talked earlier. I literally just got back from Israel after being there for 2.5 weeks. I'm not gonna lie.
Amazing.
I still think I'm on Tel Aviv time. But so let's explore that a little more. I mean, as for me personally, I've actually been to Israel to various to various technology conferences there. So I'm very well aware of the infrastructure there. But for those who may not know, I mean, why is there so much of fast-paced innovation happening in Israel right now that's now interesting to you to find all these new potential interesting ideas?
Well, Israel has a reasonably long history of technological innovation. I mean, most people don't know that, for example, the x86 architecture for Intel was founded in their Haifa design facility in 1974. So you can make an argument that Intel is actually an Israeli company, at least the part of Intel that's worked in the last 40 years. And so it frankly is not that new. It just isn't that well understood. Israel has had to do it by design, right? I mean, they are, regardless of putting the politics aside, they kind of they live in sort of a bad neighborhood and have had to, by necessity, come up with creative ways to defend themselves. And so that has led to these great innovations, which have then ultimately resulted in really interesting growing companies. One of the problems in Israel is that they have tended to not grow larger companies. In other words, their technology and innovation is so amazing that they end up getting taken out at some point by the larger American brother.
I literally was just gonna say. I mean, it like all these amazing Israeli companies get taken. Waze, WhatsApp. I mean, you can continue. You can name a full list.
Yeah, so I mean, it hasn't stopped us from, and it won't stop us from continuing because they keep growing new ones. But again, it's another argument for why we did the venture capital. Our largest holding in our entire portfolio of companies in this firm is an Israeli company that's private, and so we're perfectly able and willing to go find companies that are new startups in Israel. And they call it the Startup Nation. There was a book by that titled by Dan Sinor a few years back. And I will give huge hat tip to our partner in some of these companies, George Gilder, who wrote the Israel Test, which if you want a really significant treatise on why Israel is what it is beyond the Startup Nation stuff, I would highly recommend the Israel Test, a book that George wrote a few years back also. It's just an amazing community, and you've been there so you can see it. When you walk around Haifa or Yokneam, some of these tech centers, and right in Tel Aviv for that matter, the buzz that you get is amazing with respect to just you can almost feel the ideas flowing. I mean,
from Technion to Weizmann Institute, And it's funny because you're in California as well, so the bird craze and the scooters. I mean, there's more of the scooters there right now than there are even. I'm in LA, so even in Santa Monica. I mean, it's pretty incredible.
No, it is an amazing place. So, that's the answer to your question of how do you find things. You go in places that maybe people aren't thinking about. Now, it certainly is not undiscovered now. I mean,
Sure.
The world is aware. And yet we're still amazed at how many people still, kind of don't really, understand that or are not aware of it. Certainly when it comes to individual investors, I don't think they're as turned on to it. But there's still, great opportunity. They have the same problem though that we have here. Not enough public companies happening.
Right.
Partly because they're getting taken out by the larger, mostly American companies, but they're able to continue to make new ones. So I mean, it never ceases to amaze us, whether it's in core technology or whether it's medical technology, biotechnology, whatever. It seems like there's always something new coming out of Israel. And the symbiotic relationship between Silicon Valley and further America and Israel is so significant. I definitely don't think, I'm not even sure a lot of people who are, larger institutional investors that might be in Israel really understand how important that is. I mean, it's the two really, in many ways, need each other. So yeah, I mean, it's something that we expect we'll be doing for a very long time.
Cool. And for those who are listening to this and have not been to Israel, highly recommend going. It's a lot of fun. If you have any questions on it, please feel free to contact me. And it's an amazing place. Very big fan. All right, so I'm going to do a little transition here because one of the reasons we ended up now having you on the podcast is some of your macro commentary on what's going on in the markets and what some of the things that you've been seeing. And while our focus here at Planet MicroCap is on microcap investing strategies and learning different ways one can make money investing in this asset class, I'd really be remiss if we didn't take into consideration what is going on in the macro universe. So we're recording this during the first week of September 2019. So, from your perspective, what do you see going on or what do you see happening in the broader equities markets?
Yeah, I think there's this sort of prevailing, I would say, attitude or tendency. Well, heck, I mean, since the 08-09 crisis, pretty much every year we've been hearing a drumbeat from what we like to call the sort of the financial punditry that we're going into recession. I mean, we're just on the very cliff's edge of dropping into a recession. And therefore, and also we're going to have this deep, prolonged market correction because of that. Now, I'm prefacing all of this, as you can imagine, based on what we believe to be the growth stock theory of investing. We have a saying in our shop: we don't do the market, and that's really true. I mean, if we're saying that we're going to own companies through multiple market and economic cycles, then we really are focused on the business. But you can't possibly be in this business and still not have some thoughts and ideas with respect to the bigger macro picture. And actually, because we also kind of call that theory of investing a narrative-based approach. So we're building narratives around what we think are going to happen or think is going to happen with respect to where the growth is in the economy and what have you. And so you can't not be paying attention to the macro picture if you're going to be building narratives around what you think is happening. That it's just our macro picture might be larger than the overall economics. It is larger than the overall economic cycle, but it doesn't change that what's happening with respect to the economy does have an impact on multiple long-term narratives that we want to put in play or that we want to exploit. So that being the case, we think that this kind of constant drumbeat of negativity, which I think plays into the 8,000 to 4,000 problem that I mentioned, in that, if you go back to, the 21st century, for all practical purposes, has been, just one crisis after another, right? I mean, we started off with, first of all, we were going to have a crisis. Y2K was going to end the world. That didn't happen. The dot-com blow-up, which really, it was quite unfortunate because as much as the formal, if you will, dot-com world needed to get burst, I mean, we used to laugh back then at companies, could get financed as long as they had .com in their name. And it was pretty much true. That crazy, overvaluation, if you will, that happened. Let's not forget that the NASDAQ was 5,300 in 2000, and it took, 15 years or so to get back to that point. I mean, it was pretty amazing. I would argue that was a good thing to have happen. The problem is that it took it lumped tech telecom in general into the .com mess and created a veritable depression in the telecom sector, which frankly we're still feeling some of the ramifications of today. It's remarkable that telecom has been able to build out bandwidth to the extent that it has with this, what it was really been kind of a considerable lack of focus from the investment world that but abandoned it post 2000 .com blow up. Then you go to 9/11, and I'm not sure that we have not really fully appreciated just how important 9/11 was to the psyche of things. I think it was, the horrible event that it was. I think it had significant ramifications to this whole concept of risk is a bad thing. Now, .com certainly contributed to that, but I'm not sure that 9/11 wasn't even more responsible for that. Fast forward a few more years, we get 08, 09. So, I mean, it's been one, crisis after the other, and when you think that we've had, a couple of 50+%, almost, I guess 60% from top to bottom in the S&P 500 twice in the first years of the 21st century. We hadn't had anything like that happen since the early 70s. And then we had two right in a row. Mm-hmm. And so I think that really has played into the overall, mentality that we're getting. We're now, I call it the crisis industry. The crisis industry is out there on a 24/7 basis selling crisis. And, the average investor out there, I think it's a huge problem getting caught up in that whole mentality, because it is noise. It's crazy. And yet I think it's partly why we have the 8,000 to 4,000 problem, which was created largely by some of the regulatory mishaps that I think have happened, whether it be Sarbanes-Oxley or Regulation FD or the analyst scandal. I mean, we can spend a whole nother 10 podcasts talking about each one of those. But I mean, there's been this overreaction, which may be natural, this tendency on the part of people to want something to be done to stop this from happening again. And government, in its infinite wisdom, answers that call with some form of regulatory, action that I think, unfortunately, the law of unintended consequences starts kicking in, and that's how we end up with this sort of spiral. So this long diatribe, where am I going with this, is to kind of say that, this idea that the market is overvalued or somehow in this bubble, I think is fanciful. I mean, if you go back to 2000 to today, it's going to come up on 20 years next year. The market has been below average in its return over that whole period of time. I don't think it's right to go back to March 9th, 2009, the bottom of the 08-09 debacle, 60%, I think, down on the S&P from peak to trough, and say that now we've had this unbelievable bull market. Mm-hmm. I mean, I think you have to take the whole century, go pre-2000 before you can really make any argument about values in the market. And if you do that, you haven't had anywhere close to the kinds of returns that really, would be considered normal in the previous 75 years before that. So I think our main point with respect to the macro picture is you're going to just continue to hear this constant beat of negativity. Unfortunately, I think it's actually become a political issue on both sides of the equation. Yeah. Depending on who's in power, the other side wants to argue that the economy is going into a mess because they did it. I just think that it is problematic. Perhaps it's something we can benefit from in our business, because I think the noise is so great that the average person might just have so much difficulty dealing with it that, it's why we have a job. We've always said, really what we're doing, if we're doing it right, is not that complicated. It's just tedious and time consuming. Yep. And requires an extreme level of discipline. The macro environment has been so inundated with financial engineering and this idea that Wall Street wants to sell people that, you really need our sophisticated algorithmic approach to investing to be able to make it today. And we think that's a crock. I mean, it's complete nonsense, but that's the way the world has gone. It's part of the reason I'd say, and this is, no reflection on my past employer, but because they're all the same. But it's really part of the reason why I say we waited 10 years too long to do what we're doing, because that world is just inundated with that thinking.
Right. No, it's really interesting. It's from person to person when you ask, what's your perspective on what's going on in the market, because it has become more of almost a political stance because
Yeah.
I remember talking to one of my wife's family members and just saying, ask, what's your perspective on what you see going on in the markets in the US? And they're like, oh, it looks like it's great. Market's going up, GDP is good, things look great. And part of you is like, okay, yeah, I could understand that argument, but at the same time, there's certain things that are happening that could be seen as manipulation to make it so that the market's better. So it's really interesting when, especially when we're going into a 2020 election where a lot of things might be done in order to make it seem like the market is continuing to grow and things are great. And then, so it's fascinating. Look, I'm still young in this business, so I've obviously never seen anything like it before, but it's tough to kind of wrap your finger around. That's why I focus on microcaps. It's a lot easier to just focus on companies performing.
Well, and that's ultimately what we're saying too. So,
Yeah.
I give you a macro perspective and then I say, but I don't pay much attention to it other than to try and develop my narratives over, not that cycle, but, what are these big economic trends that we can build a narrative around and then go look for companies that fit that. And that's exactly how we approach things. And then we're going to own them through whatever garbage that gets thrown at us because of the nonsense that goes on a day-to-day basis.
Right.
So, if you look at, I tell people all the time, and you well know in California, we're originally from the Bay Area, now on the Central Coast because we didn't want to be in that craziness anymore. But, real estate is such a huge piece of people's worth here in California. We often use the real estate analogy as a means to try and explain what we do. And what I mean by that is, people don't think twice about owning a piece of property through multiple market and economic cycles, right? It's like the epitome of long-term investing, and it's almost taboo. What do you mean sell my real estate? We'll never do that. My father and grandfather would kill me, or roll around in their grave and come back and haunt me. We try and get people to think about investing in companies similarly. If you look at private companies, family-owned companies that have been in a family for generations, and that's, by the way, what T. Rowe Price was often referring to when he talked about the great fortunes that were made in the country. We're owning businesses through multiple market and economic cycles. Well, that's what he's talking about. There's no reason that the average person can't take that same approach to things and view investing in companies the same way. Again, takes an extreme level of discipline, and you have to be extraordinarily tedious in watching what's going on in that company. Have to, really have your methodology for, evaluating, are they well managed? Are they in front of a fertile field of future growth? But at the end of the day, if you would be much more like real estate investors, in your investment in companies and public companies even, then I just think we'd all be a lot better off. And actually, if Wall Street, which this is asking way too much, but if Wall Street took more of that approach, we might actually have a much more sane market environment. We wouldn't have these situations that we have today, where I don't think we would anyway. Maybe I'm wrong. Where you come in and some silly issue has happened at a company that is likely transient in nature, and the stock's down 30, 40, 50%, and especially in that microcap world. And it's happening even in larger cap names these days. Mm-hmm. It's just ridiculous.
Oh, yeah. So, as we talked about here, every news outlet has been talking about recession warnings, and you've actually published a couple articles. I think it's called your Investment Climate blog, if I'm not mistaken. And you discussed some of the signs of recession warnings and how investors can prepare for potential downturn in the markets. So do you mind going through some of those main points?
Well, one of the things that, again, going back to what our theory is we're going to own things through multiple market cycles and economic cycles. But you have to be focused on, and I'm assuming obviously we're talking about individual investors here, but
yes.
I mean, heck, institutional investors still have similar needs to plan,
True.
Right? So I think as long as you've planned properly and you've got the right funds in long-term investment as they should be, then you just kind of ignore the ups and downs. That said, I don't think it necessarily needs to be considered a trading strategy. That if you've seen a market which has had maybe multi-year run up and you've got new cash to invest, I kind of always like the idea of, well, you know what, maybe you don't commit all of it all at one point here. Maybe you can commit half of it and then keep powder dry for purposes of taking advantage of dips when they happen. And, maybe look for, what would drive you to invest. Maybe have a rule that, well, if I see anything more than a 10% drop in a position, I add to it, or in my overall portfolio, then I add to it. And that combined with regularly making investment, I think if there's one thing, this is for sure geared more towards the individual investor. If there's one thing in our dealings with individual investors that I think I'll say, I don't know that I'll say we failed at, but people haven't necessarily listened to our suggestions on this, is not enough people make regular investment into the marketplace. Mm-hmm. And yes, people are doing things like 401ks at work and all that, but that's not enough. I mean, you need to find a way to pay yourself. And in paying yourself, it means funneling money into an investment account that is meant for long-term investment. And you can even use a similar approach that I just explained, where half the money that you set aside gets invested and half stays available in cash for purposes of taking advantage of opportunities when they arise. I think one of the things that we only run, we run four strategies in addition to the venture fund. So it's, I guess, essentially 5 strategies, but our core growth strategy, and then our income strategy, which is really an equity income strategy, just, dividend paying type stuff and what have you. And then the Israeli strategy that I mentioned, which is a carve out of core growth, and another small cap strategy we call Aspire, that's a carve out of core growth, just super high tech, high aggressive, again, high conviction, high concentration portfolio. So as you can tell, we're not looking to make investments in fixed income type securities. I think there's a time and place for fixed income. We don't think that they're as broadly necessary as what most people are told over their lifetime. I would actually prefer that people make investments in equities and then keep larger amounts of cash if they need comfort. And then you have something available to take advantage of dips when they happen. And especially given kind of the secular down we've had in interest rates. Now, maybe we're living through a new period where interest rates are going to stay relatively low. I have my doubts on that, given still a fiat currency world that we live in. I think somewhere along the line, inflation ends up rearing its head, and if you've made investments in 30-year bonds or 20-year bonds, that could be pretty painful. I'd rather, if the difference is 2 or 3% versus 0 or 1%, frankly, I'd actually rather take the 0 or 1% to have the liquidity available so that when the inevitable debacles happen in the market, I can take advantage of it. So that might be one sort of approach that we would take that's maybe a little bit different than normal.
Gotcha. All right, so I'm gonna now get to one of my favorite questions that I love to ask. I ask this to every one of my guests, and for you, Gerry, what investing experience would you say you learned the most from in your career, and has that affected your current investing thesis?
Yeah, I won't, just like when you asked me originally, was there a specific event that made you go into this business? I'm not going to say that there was a specific event, but I can say that whenever early in my career that I tried to trade the market or outguess the market, it was a monstrous failure. And I learned pretty quickly that I know I can't figure out what the market's going to do tomorrow or the next week for that matter, and probably not even the next year. In fact, I'll argue I don't know what the market's going to do at all. I do know that over time, history has obviously shown us that the market tends to go up. But again, that's that term market. And so what lack of trading prowess did for me, thankfully, was teach me that I better figure out what is a good business. Mm-hmm. I better figure out how to find a good business, because the market value of that business takes care of itself if you've got that part right. And you don't end up having to worry over time about what's the craziness of the market going to do. I meant it when I said that in our shop we say we don't do market. We really don't. It's not to say we won't reduce a position if it's overweight in our portfolio. Yeah, we will. But that's really, that's more of just kind of stay prudent as professional investors. I think that's the single most important lesson that I learned over time was if you're trying to be smarter than the market on a day-to-day basis, you're going to have trouble. Mm-hmm. And I really haven't seen, I can say in 34 years, I haven't seen any professionals that have been consistently successful with a pure trading strategy. At some points, it ends up not working. And oftentimes at the most critical point. I mean, that's that algorithmic approach to investing, for example, where they're always coming up with new algorithms. And, they tend to fail at the most critical times. I mean, 08, 09 was just a classic example of that. Mm-hmm. I think that was, I coming into the business thinking I was really smart about how to outguess the market, and those failures were certainly things that drove me to taking the approach that we take today, and I think it was the best thing I could have happen.
Isn't it nice to be humbled by the market? I love it.
Yeah, it's painful sometimes, but that's why we try and avoid it. We just when the craziness is happening, we're just we're talking to companies, we're talking to the CEOs, and getting their perspective, and for us, from our perspective, that has helped with our interaction with clients. I mean, when craziness is happening out there and clients are like, oh my gosh, what do I do? We start talking about, we talked to the CEO of such and such yesterday, and this is what he sees happening in his business, or this is where they're going over the next few years, and lo and behold, that tends to add a level of comfort, and certainly to us, and we find that's actually where our clients end up as well.
Cool. So then what advice do you have for new investors that are looking at investing in equities?
Definitely exactly what I had said before. You have to make regular contributions into the market. One of the things that we're probably most proud of is that we started the core growth strategy in the form of a fund because we wanted to be able to, the realities of separately managed accounts are that you have to take larger account sizes. It just doesn't make economic sense for us to be managing a $10,000 account in a separately managed strategy. It doesn't work. But I always had a problem with that from sort of just a philosophical and societal standpoint. I wanted to be able to say, if that guy out there wants to put $1,000 into an investment and be able to put $100 a quarter in, I want to make sure that I can help him manage his money. And what's most important for that guy is to continue putting regular amounts of money in over time. If the younger you are, if you start doing that early, and make it a habit. Like I said earlier, pay yourself, send yourself an invoice. And it probably should be about 15% of your gross. If you can't figure out a way to put 15% of your gross away, you're spending too much money. That should be a sign. And I'm not talking about 401k. I'm talking about over and above 401k. I don't care, what you have. I mean, you see so many people out there spending how much every month on their smartphones, right? I mean, if you can put that kind of money in a smartphone, don't tell me you can't put money into your investment account. That's the advice I would give is, and be kind of ruthless about it. Like, I don't have any sympathy for people that don't take that advice.
Oh no, I feel like I'm ahead of the curve right now. I mean, I'm very prudent.
Good.
I'm always like 30%. put that,
Good.
So that's good to know. I'm passing the Taylor Frigon test right now.
Most definitely.
So Gerry, where can my audience now go and find more information about you and Taylor Frigon Capital Management?
Yeah, so taylorfrigon.com, taylorfrigon.com. From there, you can go to our fund website for our core growth fund if someone wants to buy our fund. And directly, that's taylorfrigonfunds with an S.com. Best way to find out about us. You can also click on the section on our website about our views, and you talked about me writing a book. I pretty much have via the blog. I think there's over 800 posts over 12 years in that blog. We tend to like to write, so we haven't done as much now, but mostly because we've already written so much of what we want to say that there's less and less reason to write our blogs anymore. But you can get a lot of insight into how we think and in the section on our views and go to our blog.
Great. All right. Well, with that, Gerry, thank you so much for joining me today for this podcast, and I'm excited for the next time we get to chat.
Great.
All right. I'll talk to you soon.
Thank you.
Bye-bye.
Bye-bye.
Thank you all for tuning into the Planet MicroCap Podcast, and thank you, Gerry, again for coming onto the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast, as well as Stitcher, Spotify, and YouTube. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.